Welcome to the course on buying call options and put options. My name is Harry Swaminathan. I'm the founder of OptionTiger.com, a cutting-edge site with options education, mentoring, and trading ideas. I have a bachelor's degree in engineering from India and an MBA from Columbia Business School in New York. In the previous two courses, we studied all the theory behind options. And if you've not gone through any of that material so far, then you should do that now. Options are a mathematical concept, and there's quite a bit of theory to cover before we can actually get into trading options. And this is one of the biggest mistakes that beginners to options make. They think they know how call options and put options work in all ways, and they put on trades and they make mistakes and lose money. So it's very important to take your time, be patient with the learning process. If you've gone through the previous two courses, then you have a much better appreciation for all the nuances of options trading. And in this course, we're going to get into live trades, and we're going to look at various criteria for getting into call options or put options. So let's look at the course agenda for this course. In this course, we're going to do two live trades. One is we're going to buy a long call, and the second trade is we're going to buy a long put. Now, the first thing you have to ask is, what is your criteria for either going into a long call or a long put? So it's important for you to have an outlook for your stock. So what do we mean by that? If you're bullish about a certain stock, then there must be some reasons why you're bullish. And if you are bullish, then how long is that outlook valid for? It could be valid for a month, it could be valid for 3 months, or it could be valid for the long term. So you have to have an outlook before you take up a position like a long call or a long put. And you have to have certain validations for having that kind of an outlook. So here we look at how you can look at some of these validation points. And we'll also look at what we call a swing trading approach. A swing trading approach is slightly more shorter term than a long-term investor. We've seen in the markets generally go through quite a bit of up and down cycles. And because options also are structured on a monthly basis, on a weekly basis, and a quarterly basis, you can construct some very creative strategies if you adopt a swing trading approach. So a swing trading approach really takes advantage of 1 month cycles or 2 month cycles in any given stock or the market. And it is these cycles that allow you to either go take a bullish strategy, or you can take a bearish strategy, and the time frame for that strategy is somewhat limited, maybe 2 weeks, maybe 4 weeks, maybe 8 weeks. But you're looking in that time frame, in 1 to 2 months. And once you take that kind of a swing trading approach to your trading, then you have the ability to take advantage of all the different market cycles that we've become used to seeing. So that's the general approach for all of the trades that you're going to see. You open a trade, and even though you might get into an option series, into an expiry series that has 2 or 3 or 4 months left on it, it doesn't mean that you're going to hold these positions for that long. You're only giving yourself enough time, one, for the trade to play out, and two, you want to reduce time decay, because bear in mind, these are long calls and long puts. Both of these options are going to lose time decay on a daily basis. So you want to be able to reduce that amount of time decay on your options. So even though you might take a trade with 90 days to expiry, it doesn't mean you're going to hold it for 90 days. So that's in general the principle behind the selection of all the expiry series, especially if you're going to take up a long position. Now, if you take up short positions, then it's a different case. In the case of a short position, you want to be able to accelerate the time decay because time decay is in your favor in that case. Even though we're not going to be taking short trades in this course, because selling naked options is just not a desirable strategy, and besides, many brokers might have an issue with that. Your margins are going to go sky high, and you have an unlimited loss profile on those naked sells. But we're going to study the risk profile of those naked sells, and as we mentioned in the earlier two courses, you can always convert a naked sell to a spread. And really, that's the right way of getting into a selling position. You always want to do it as a spread, unless you've reached a very advanced level and you want to pick up stocks that you like at prices that you like. So if you recall the first course, we showed you a way where you can pick up stock that you like by selling a put option. So unless it's very specific uses like that, we would highly recommend you don't do a naked sell, at least until you get to a certain advanced level and you have a full understanding of how the naked sell works. Then in this course, we'll also be looking at strategy and optimization. So we also looked at this aspect briefly in the first course, where because we have four options, we can buy a call, we can sell a call, and we can buy a put, and we can sell a put. So there are four basic strategies available to you when you just use single options. And you'll have to decide which of these strategies are best for your outlook. And that's what we mean by strategy optimization. Out of these four strategies, two of them are bullish and two of them are bearish. So when you buy a call option, you're bullish. And also when you sell a put option, you're bullish. When you buy a put option, you're bearish. And when you sell a call option, you're bearish. So out of these four, first of all, you have to decide whether you want to take up a bullish strategy or a bearish strategy. And once you decide that, you'll have to decide among which of these two strategies that is better for you. And if it happens to be a short position, which is either selling a call or selling a put, then you never sell it as a naked sell. You always do it as a spread. Now, we're going to cover spreads in detail in the next course. But the principle is the same. When you sell a spread, all you're doing is you're limiting your unlimited loss profile. But otherwise, in all other ways, it's just like selling an option. So we'll get into spreads in that course. Then finally, once you've put your options position, then if everything goes well, that's great. Your option is going to make a profit. You're going to be able to exit in whatever time frame. It's always good to have some set exit points in terms of your profit target. If it hits your profit target, then it's many a time it's worthwhile to just get out of the position and get into a new position. But many a time things don't go as planned. Very often you're going to see that your options position, your stock, is moving against you. And if it's moving against you, then what do? Fortunately, this is the greatest feature of options. You have the ability to adjust your positions, which you don't have in stocks. That is the big difference between stocks and options. Stocks are fairly inflexible from that standpoint. If you buy a stock and the stock starts going down, what are your options really? You either sell the stock and book your losses, or perhaps you can cost average some more. But again, if the stock is in a downtrend, you're going to see paper losses. And even by cost averaging, all you're doing is getting deeper into the problem. And so many investors have been burnt by this cost averaging strategy that overall it's not a very good strategy. Fortunately, with options, you have the ability to adjust them. And with single option adjustments, and we'll see in this course, if you have a long call, so you have a bullish position, you have a long call, but the stock is going down. So it's going against you. So what do you do to this position? What can you do to this position? And of course, a lot of these adjustments that we talk of involves getting into a spread position, because you need a second option to neutralize the first option position. So whenever there's two options involved, it becomes a spread. So option adjustments are key, and every position, whether it's a single option, whether it's a spread, whether it's a advanced four-legged option strategy like an iron condor, it doesn't matter. The greatest feature about options is that you can adjust your positions, and that's very critical, because you can always adjust your position to either cut down your losses, come back to break even, and in many cases turn a losing position into a winning position. So that's very key. So adjustments, if you recall, is the third leg of the stool. So whenever you get into options, you have to be prepared to adjust them, because nobody's perfect, not even the professionals. They might take a position, but they have no idea if it's going to work out or not. And therefore, it's critical that you learn the art of adjustments. And the way you approach adjustments is, if you know how to adjust a single option, then you will automatically learn how to adjust a spread. And if you know how to adjust a spread, you can always adjust a four-legged option strategy like the iron condor. So adjustments are key. We'll be focusing a lot on adjustments, not only in this course, but in future courses as well. In this lecture, I want to give you the criteria for the long call and the long put. So, and then after this, we'll be going into the live platform and we'll put a trade and we'll monitor the trade and we'll do stuff like that. But, if you're going in for a long call or a long put, you have to understand a few things. One is time decay is going to be your enemy, because you are a buyer of options. Think of yourself as the buyer of the house in our previous two courses. Time decay is against you. The option that you buy has a fixed amount of time before which it has to make its move. And therefore, and because you pay premium, you're starting off at a disadvantage because of this premium. So if you paid $10 or $20 for an Apple option, you're automatically starting off at a disadvantage, and your position has to overcome this premium and then some more. So time decay is your enemy, and therefore what that means is you have to choose your expiry with enough time for your trade. So in general, if you're going to take up a long call or a long put, you should at least give yourself 2 to 3 months. Because in the final month, time decay is going to be really exponential and it's going to hurt your option position. In fact, even in the second month, it's going to see some significant time decay. Therefore, I would recommend that if you're going in for a long call or a long put, you choose an option, you choose an expiry series which has at least 90 days to expiry. Once you've decided that which expiry series you want, you have a number of choices to make after that. One is your choice of your strike price, and the other is the number of contracts. If you're going to buy a long call or a long put, you basically have a few different choices in strike price. In fact, you have many. You could buy an at-the-money call option or a put option, in which case your delta is going to be 0.5. But that is the delta of that option. What really matters is your position delta, and that depends on the number of contracts that you buy. As a general guideline, if you're a beginner to options, I would highly recommend that for the first month or two, you trade these long calls and long puts on a paper trading account. Thinkorswim has it. Most of the good brokers have. You might have to open the account by funding it with a minimal amount of money, but you should definitely paper trade these, and so that you have a clear idea of how these options move, how your profit and loss gets generated, and there's no point in experimenting with real money. This is again, I have to point out, in options trading, most people lose money because they think they understand it, and they put on these trades. These trades go against you, and you end up losing money. So long calls and long puts are simple options for the most part. Regardless, I think you should at least trade 10 to 15 trades on this in the first couple of months. And once you've gotten an idea of how these options move with respect to the underlying, then you can put in your real trades. Because your in the money, at the money, and out of the money options are going to move differently. And with changes in volatility, your option prices are going to change. And as time passes, your options are going to lose some value. So all of these things put together, it takes about a month or two to look at all these things, look at all the Greeks, look at your position Greeks, position delta, what are the volatility levels, and understand how your options position is going to fare. And this is very critical. So then we look at, if you're taking a long call or a long put, you have to make sure that you have the right number of contracts, because the number of contracts decides what your position delta is going to be. Then, of course, why did you get into this trade? What was your criteria? What was your trade rationale? Is this trade in line with the market trend? Because bear in mind, most stocks behave in line with the overall market, which is the S&P 500 index. Did you look at current volatility levels of the stock? Did you look at current volatility levels of the overall market? So how did you choose the trade? Did you look at the chart? Did you do any technical analysis? And if things go wrong, what is the backup plan? So this is the basic stuff that you need to analyze before you get into a long call or a long put. Now, what we're going to do is, I already have two trades made, one on Chipotle and one on FXE, the Euro ETF. These are trades we did some time ago, but the concepts remain the same. So in the rest of this course, we're going to mix and match these two trades, and then once we've had a good opportunity to understand the long call and the long put, we are going to talk about the naked sell and why we don't want to put a naked sell, but at the same time, we want to see how we can get into, we want to try to understand the seller's position, because if we do get into a seller's position, we would be putting in a spread. And so even though spreads are covered in the next course, we'll look at these positions, we'll look at these trades, and of course, I'll be covering all the other topics that we mentioned in the course agenda. I'll see you in the next lecture.